Hello traders, the title of this video is how to handle an Elliott wave count that becomes too complex. Let's get started. We're on a yearly chart and we are looking at ESON Mobile Corporation, the APXXOM, X-ray, Oscar, Mike. This is a Dow Jones component. In fact, I need to remind traders that ExxonMobil is a market leader for the Dow Jones index. So how one can handle an Elliott wave count when it becomes too complex? Alright, so as I told traders, it's quite easy to count Elliott wave on a higher time frame like a yearly chart. But as you will go through this step by step, you will notice that it doesn't look very simple as it sounds on the yearly chart right now. And you will notice quickly that our wave count is becoming a bit too complex for me personally, maybe not to you, but let me know in the comment section whether you figure out what is happening here. All right, so on a yearly chart, looking at the chart here, one can quickly say, all right, first wave. All right, one may say that, okay, preliminary wave count. All right, one may say second wave, quite horizontal here, and one may say, okay, third Elliott wave, okay, and one may say this is the fourth Elliott wave on the yearly chart. Right? And one may say this is the fifth Elliott wave that has been extended. At this point in time, one may be thinking that, okay, a correction is underway, and one may be thinking that probably it's a flat correction. So I will start putting a bit of color into it. All right, orange for the flat. One may say, okay, George, it looks like a flat correction is underway for the ExxonMobil. And one may think that, okay, it's going to come down, 1, 2, 3, 4, 5, move down. So something like this, okay? Maybe this one a bit too far, okay? All right. And then something like this, bringing this to the beginning of the A part of the flat correction in this zone here. All right, something like that. So 1, 2, 3, 4, 5 down. All right, will you accept that? Okay, on a yearly chart, that's all. I mean, one may think that it's happening. All right, so referring to the video that I posted last time about how to play the mind game of Elliott wave trading like a pro. All right, we said to traders that we must go into the mind of other traders. So remember this wave count. So once counted 1, 2, 3, 4, 5, thinking that a flat correction is underway. 1, 2, 3, 4, 5. So you may consider this that this is your wave count. All right. Now we want to go into the mind of other traders. Okay. All right. So another trader may say, George, I'm not quite happy with the data that we got here. That probably there are data missing. There is okay, charting data missing. So that trader may say, oh, George, I don't want to call this one the first wave because I'm not satisfied with the data that we got here. I would prefer to have more data. Probably there was a consolidation in this session. You never know. So therefore, I will call this one the first wave. So this will be my first wave, second wave, and third wave. Just can't you see that in fact in 2003 we have okay, a commodity boom, okay, metal, all right. So a lot of okay. There was a commodity boom from 2003. You can see that from this is 2003. There was a big move in the commodity market. So George, can't you see that this is the third Elliott wave, all right, followed by the fourth Elliott wave, and here we have okay. Hold on, please, my friend. Here we have the fourth Elliott wave, and here it is the fifth Elliott wave. All right, George. This is the fifth Elliott wave right here. And one more time, George, there is no Elliott wave violation, okay, because the fourth wave is not overlapping the first wave, and the third wave is not the shortest wave. All right. So somebody may think that, okay, George, this is where the correction has begun now. So what we are doing now, we are going to the mind of other traders to see what they are thinking. All right. So they may say, okay, John, this is now the correction underway here. All right. So he or she may think that probably we're going to have a zigzag or a flat correction in the form of 1, 2, 3. 1, 2, 3. All right. 1, 2, 3 again before the last 1, 2, 3, 4, 5. All right. 1, 2, 3, 4, 5. So I'm just going to put this one down as another 1, 2, 3, 4, 5, something like this. All right. So going into the mind of other traders that may say, George, you don't have enough data. If you did have enough data, probably you'll notice that this is not the first wave. That in fact this is the first wave. Okay, right here, second wave, third wave, fourth wave, and the fifth wave. Because from 2003 we have a commodity boom, and it makes sense that this is the third Elliott wave, followed by the fourth wave and the fifth Elliott wave, and the correction is now underway. All right. But one thing, if you look at this wave count that we are talking about now, you'll notice that the fourth Elliott wave is quite deep. Look at that. It's quite deep, yes or no? It's quite deep. So normally the fourth Elliott wave is quite shallow, yes or no? All right. If you apply Fibonacci retracement, you can see that that fourth Elliott wave went down to 61.8% of the third Elliott wave. But you will have to notice that it's a strong bullish move. If we have a commodity boom from 2003, the market is quite bullish, yes or no? So we will not expect, all right, the fourth Elliott wave to be deep at 61.8%, yes or no? Because if the market is saturated by the bulls, all right, if we have a strong commodity boom, a bull market, all right, one will not expect, all right, the fourth Elliott wave to be quite deep as it is. And also, as this particular trader is expecting a flat correction usually takes place after a strong bullish move. But here we have a fourth Elliott wave that is quite deep. Personally, I will be thinking what's going on here, why they sell it so much like this, though the market was quite bullish. Looking at, all right, yes, there's another reason here. We may justify that. They may say, okay, George, are you stupid or what? Remember in 2007, so the justification for this deep move, maybe, yes, maybe. Well, in 2007, we have the financial crisis. So the bearish financial market was 2007, pushing it down all the way to 2009 before the market resumed. So that will be a valid justification for this move down. All right? But normally, the fourth Elliott wave should be shallow. But if we think of 2007, the financial crisis, so we may say that, okay, it is justified that, okay, this should be, all right, quite deep as it is here. All right, they get away with it. Okay, that's good. Okay. All right, but it's not finished yet. You will notice that the wave count is becoming a little bit more complex, all right? A little bit more complex. So what we're going to do now, we're going to go now to the monthly chart, and we're going to start looking at the internal wave to see whether what we are calling impulsive wave are truly impulsive wave, all right? So I'm going to start removing some line because you will quickly notice that this wave count is not as straightforward as anybody will expect it, and it's becoming very, very complex. So we all agree that for my first wave count, we were labeling something like this as an impulsive wave, and we were labeling this one also as an impulsive wave, and we were labeling this one also as an impulsive wave. And the last gentleman that we were talking about earlier on, going to the mind of other trader, was labeling this as the fifth Elliott wave. But let's look at the internal wave of this. It is an impulsive wave. Look at this. It doesn't look like an impulsive wave if we examine, all right, or dissect, so to speak, all right, the internal wave or this price structure here. But this is what that gentleman, those traders are calling the fifth wave. It looks to me 1, 2, 3. I think all the children will agree with that. 1, 2, 3. So I will quickly discount this as a fifth Elliott wave because it does not have the structure of an impulse wave. Now, feel free to disagree with my wave count. The comments are very welcome in the comment section. Do you think this is an impulse wave? What is happening here? I do not think personally that this is an impulse wave. What do you think? All right? But as we were going to the mind of the second trader, we noted that he or she was calling this as a fifth Elliott wave. On the yearly chart, it looks like, going back to the yearly chart, it looks like, okay, an impulse wave. It's a straight line, yes or no? So you say, okay, 1, 2, 3, 4, 5, yes or no? But now that we go to the monthly chart, the price structure is telling us, George, it's not looking good. So we will say, okay, if you all agree, we will not call this one as the fifth wave. So we may say that, all right, for those traders, they can keep their wave count, but we don't want to follow them, okay? But look at this one also that I call 1, 2, 3, 4, 5 as a fifth wave. Let's look at the internal wave of this section here. Let's zoom into it. Let's zoom into it. Is this, okay, an impulse wave? Now, you will notice that in 2003, as I was telling you, you have to remember what is happening in the financial market. 2003, we have commodity boom. 2007, financial crisis. Okay, 2009, the stock market has become bullish, and so on and so on. All right. So you need to remember those things that will also help your wave count. Okay. So 2003, suppose you were here and I say, okay, this is okay, my fifth wave that has been extended. But so we will say that fifth wave has been subdivided into 5 mana waves. So first mana wave of that fifth wave, followed by a triangle here, which is our second mana wave. And where is our third Elliott wave? Here it is. Is it? Is this the third Elliott wave? Followed by the fourth Elliott wave, and the fifth mana wave of our real fifth wave. Quickly, you will notice that the third Elliott wave is the shortest wave, the shortest impulse wave in comparison to the first and the fifth. Therefore, there is an Elliott wave violation. We cannot call this one here as a third Elliott wave. We are violating the Elliott wave principle because if we label this first mana wave or the fifth wave, second mana wave or the fifth wave, third mana wave or the fifth wave, and fourth mana wave or the fifth wave, and fifth mana wave or the fifth wave, all right, we are violating the Elliott wave principle, and therefore it's not adding up. All right, so we will say, all right, okay, let's remove everything. Maybe we were a bit too, okay, so we will say, all right, probably we were a bit too, okay, ambitious. So probably we say our first Elliott wave has started, you can't deny it from here, not from here. One may say, all right, George, are you blind or what? Okay, here it is. There was an inverted head and shoulder chart pattern. You said it yourself. Okay, there was an inverted head and shoulder chart pattern here. And this is the first wave, second wave. And one more time, our third Elliott wave is still the shortest in comparison to the first and the fifth. What's going on? So, all right. So you'll be thinking, oh, probably that third mana wave, all right, has been extended. So we say first mana wave of that third Elliott wave, second mana wave of that third Elliott wave, and the third mana wave of that third Elliott wave. But you will quickly notice something, all right, that our fourth mana wave of that third Elliott wave almost come into the range of our first mana wave. You see here? Again, we see again a violation of Elliott wave principle. Is there a market distortion? Sometimes market distortion can make our wave count too complex. So if there is a distortion that we cannot identify, say, all right, this one was a distortion. What's going on here? All right, what's going on? You can see that our wave count is becoming a bit complex. So how do you handle that situation? If you are counting your wave, you are trying to make things, okay, make sense. You want to align your wave count with the Elliott wave principle. You do not want to fool yourself. How do you handle it when the Elliott wave count becomes too complex? All right. Now, one thing you can do is to abandon the wave count. That's one first thing a lot of people will do. Say, it's too complex for me. I don't want to be part of it. I'm going away. I don't want to lose because I don't know where we are and things are not adding up for me. Therefore, I will not trade this financial instrument. Does it mean that you are you are not courageous? It's your money. You can run away with it. Okay. Another thing one can do is to try to simplify it. All right. So talking about how to handle an alien wave count when it becomes too complex. All right. Is to simplify it. You will notice that I don't want the video to be too long. That's why I want to quickly go over the main topic. How do we handle it? Even if you look at this session here on a monthly chart that we are calling our third area wave, you can see that it's quite challenging, this session here. It looks to me, you may see that there's a triangle at the top. So we may think of, okay, fifth area wave, something like that. And possibly, all right, see that there was a triangle here, that's the fifth area wave. And you may say this is the third area wave. And this section here is the fourth Mano wave. And we have a very tiny, okay, and we have a very tiny, okay, second wave there. And this is the first Mano wave. So, okay, first Mano wave, second Mano wave, third Mano wave, and so on and so on. And one more time, in this case, I think we will use the height of the third area wave. So from here to here, we compare it to the height of the first wave. It's longer than the height of the first wave. Therefore, we do not have an area wave violation here because the third area wave is not the shortest wave. All right. So we may say, all right, there was a triangle here, blah, 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 1, 2, 3, 1, 2, 3, blah, 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 in a triangle, a bit messy. So, all right, that's the fifth wave, fourth wave, third Mano wave, and so on. But definitely in this session here, though this is, I believe this is an impulse wave, it's quite challenging, all right, because 2003 there was a commodity boom. It's quite challenging to know, to see, okay, the internal wave, okay, to know exactly what is happening, unless we have been too generous with our first wave. And somebody may say, Joe, the first wave in fact breaks the resistance here. It's not from here all the way up here. But personally, I would tend to put it from here. Another trader may say, from here, now, okay, there's no more area wave violation. But you can see that too many justifications coming into this wave count. That's when you will know that your wave count is becoming too complex. So if you have to justify every wave count, all right, every, okay, internal wave, you know straight away that your wave count is becoming too complex. First, you remember, for the second trader, the fourth area wave went down too much. We have to justify it by the fact that in 2007 there was a financial crisis, and so on and so on. We have to try to reduce the size of the first wave here, and so on and so on. So we know straight away. Even in this one here, it's quite challenging. Maybe we need to zoom into it more. All right. Okay, probably because has been many years gone. That's why it's not very clear. It's also true. Sometimes with the chart, if you can zoom into it more, you are stuck with it because you can see clearly the internal wave. Then you are stuck with it. All right. But now let's go to the main topic now. How do we handle it? Okay. So I told you already that the first thing what we can do is to decide not to trade it and walk away. The reason why I'm recording this video today, as I told you in the previous video, this year our attention is about how to become a better area wave trader. So this exercise is to highlight what usually takes place when traders are counting wave. Sometimes you may come across a wave count like this that is quite challenging, quite complex, and you may be wondering, what should I do? How do I handle it? You may decide to walk away. And the next thing you can do is to simplify it. So how do we simplify it, your wave count? You will just use what we call, okay, market geometry. Just use market geometry, draw your channels, okay, draw your trend line, and focus on the market pattern. Because the reason is, the most important thing for a trader, as I told you before, is to trade the market pattern. So even if your wave count is wrong, and you stick to the market pattern, you will be all right. Now, if your wave count is correct and you are violating the market pattern, you can be in trouble. All right. So because the price structure, talking about every piece of the puzzle, we can put them together. Have you been trying to put a puzzle together and it become too complex? All right. So what do you need to do? You try to put it together. It's not making sense, as you can see. On the yellow chart looks simple, but as we try to investigate more what's going on, we are facing a bit of challenge. Either you stick to your yearly wave count, all right, or because if you can't just stick to that alone, you want to go and investigate by going to the internal wave. So when that's happened, you need to simplify your complex wave count by using what we call market geometry, the projection of a channel. So this trend line, and I just choose one point here, and I draw another line that is parallel to that line. So this is the first channel that we go. I find a support bounce, try to come down. As you can see here, it found a support near the median line of that blue channel. So when your wave count becomes too complex, you say, George, please help. And George could not help you, all right? Or you are trying to put it together. You spend hours to figure out what's happening, all right? Either, so the third option, so first option, all right? You can walk away or you don't want to trade it. Second option, use market geometry or simplify your wave count. All right. Third option is to accept your wave count and go with it. So in that case, somebody will say, I accept my wave count, it's too complex on the monthly chart. I will stick to the yearly chart. That's it. That's one option that you can do. All right. All right. You can stick to your monthly chart. But the best option in my view is to use market geometry, because now every piece of the puzzle is becoming difficult to put them together, which means the internal wave, I'll go back, I will leave the price structure and go to the market pattern. Now we are talking about rising channel, declining channel, horizontal channel, and the projection of the channel. That's how one can handle an linear wave that become too complex. If it doesn't make any sense, don't force it, don't create it, don't try to justify it so many times, all right? And people will say, what are you talking about? It's too complex. Leave it alone and simplify it. When it's too complex, simplify it. All right, so now that you can see that I draw my blue channel, so you see now, so now we will draw, we will project that channel using market geometry. Then we project it up, the width of our channel, and we draw another line right there. And here we have it, another line that is parallel to the first line. That's it. All right? Okay? That's it. And then we draw again the median line. Okay? And then you can also project it one more time, because there's a bit of price action outside the second channel. And here we are, just project it again. And now, what you are doing, you are not relying on your wave count anymore, but you switch from the price structure to the market pattern. All right? So first channel is, I'm going to color it now into red. It's quite windy in London today, so if you can hear the wind, all right. My apology to traders. So here it is, the first channel. So we project it first time, all right. And you can make decisions, all right, trading around, okay, those trend line, okay. If you like, you can project it down. If you come out of the red channel, you project it down again and draw your lines. So now, what is happening? So we are now leaving the price structure, and now we are concentrating on what? On the what? Market pattern. So there's another trend line that we can draw like this. See here? So apart from the first trend line. Okay. Now I'm going to use here, I don't want to use this low here. I will use from here, and I will draw another line that is parallel to the first line. I'm talking about this one that I will color now into green. So we have a declining channel. Right there. And we will also draw the media line of that channel, something like that. So what is happening now is that the price is falling and is heading towards the media line of the green channel. So with those lines, you want to pay attention to the intersection of two lines. You see, this point is a hotspot trading zone. There was a hotspot trading zone here before. And you want to remember the hotspot trading zone. Price can come down all the way here. This is a good one in comparison to this one here. And there are other hot spot trading zones that we need to monitor. That's it. All right. So, does it make sense? All right. Does it make sense? So what has happened here in this session that we were talking about before, 1, 2, 3, that I was telling you before, price breaks above the red channel, retest it, find a support, and go up again, boom, 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 up. But as it's going up, you see it hit the median line of the second channel, pull back, and then went back to the top of the second channel, pull back again, and then hit again the top of the third channel. Will that be useful to you as an Elliott wave trader? Yes, it will be. When the Elliott wave count becomes too complex and you don't know where you are, you can use market geometry, to simplify, your Elliott wave account. All right. So you have 3 options. One is to abandon the wave count and say, I'm not going to trade the financial instrument anymore because it becomes too complex. I don't want to risk it. Because it doesn't matter. You don't need to be courageous trader. In fact, courageous traders lose more than those who are not courageous. So don't be courageous trader. If it's too complex, doesn't make any sense. It's up to you. If you want to trade it, use a tiny stop loss, and you know that, this is a gamble, all right? But don't gamble, all right? Traders are not gamblers, all right? They are strategies. They use strategies, all right? So if it doesn't make any sense, don't trade it, walk away, all right? The second option, use market geometry, all right? The third option is to be a courageous trader and stick to your, wave count. But when I'm saying stick to your wave count, it means that where it make more sense. So on the yearly chart, it looks more, it makes more sense. So stick to that. You say first wave, second wave, third wave, fourth wave, fifth wave. A flat correction is underway here, blah, blah, blah. That's where you're going to pay attention to. But in all cases, do not violate the market pattern. Therefore, I recommend the second option. When the Elliott wave become too complex, refer to the market pattern. So the price structure is forming within the market pattern when we cannot define the current market, the current price structure. One should switch to the next level, which is the market pattern. I hope you have found this video also useful. If you have any question or suggestion, all right. Well, I really like the interaction that is happening now at 2-4 Elliott wave. Put your comment below. Do you disagree with my wave count? Do you find this video useless? All right, mark it down. Do you find it useful? All right, mark it up so we know what people like, what people dislike. So next time, all right, we focus on things that people like more and we record video in that sense. Okay, it's a voting system. All right. So thank you for watching. And speak to you soon. We are the TSTW24 traders talking about how to handle an Elliott wave count that become too complex. Happy trading to you all and speak to you soon.